In most of professional sport, an athlete is a person. In Formula One, an athlete is also a financial instrument. A modern Grand Prix driver can be worth tens of millions of dollars to a team, to a sponsor, and to a manufacturer that has built an entire marketing campaign around his face. He is also a man who climbs into a carbon fiber capsule and travels at more than 200 miles per hour, inches from concrete walls dozens of times a year. That combination creates one of the strangest insurance markets in the world. And at the far edge of that market sit a small number of drivers so dangerous or so compromised that the most experienced underwriters on earth have simply refused to cover them at all. Before we get into who those drivers were, do me a favor, if you find this kind of hidden story interesting, subscribe to the channel. We're pushing toward 100,000 subscribers, and every single click genuinely helps us keep digging into stories like this one. Stick around because the most revealing part of the story is a three-time world champion who was once told, in effect, that his own life was too risky to put a price on. To understand why some drivers can't be insured, you first have to understand how the insurance works at all. Formula One driver and team cover does not come from a high-street insurance company. It comes from Lloyd's of London, a marketplace that has been pricing improbable risk since the 1600s, originally for ships that might never come home. At Lloyd's, no single insurer takes on a driver alone. Instead, a group of underwriters organized into syndicates each agree to carry a slice of the policy. One might take 5%, another 15%, another 20% until the full value is covered. The bigger the sum at stake, the more underwriters are pulled in to share the exposure. It is risk sliced thin enough that no one player is destroyed if the worst happens. The policies themselves come in layers. There is the driver's personal life and health insurance, which in most cases the driver pays for himself because drivers move between teams and it is simpler to carry their own cover with them. Then there is the insurance a team takes out to protect itself. This is the part people rarely think about. A team does not just lose a driver in a crash, it loses a marketing asset, a sponsorship centerpiece, and sometimes its entire competitive season. So teams take out what is essentially key man insurance, the same kind of policy a corporation buys on a founder whose absence would crater the business. If a star driver is suddenly unable to race, that policy can soften the financial blow of a collapsed campaign and unhappy sponsors. When Michael Schumacher broke his leg at the British Grand Prix in 1999, it was Lloyd's underwriters who were exposed to the consequences. He was, at that point, the most valuable driver in the sport, and his absence rippled through Ferrari's season and its sponsorship commitments. That is exactly the scenario these policies exist to address. Now, here is the part that surprises almost everyone. The cars themselves are not insured against crashing. When a $30 million car is destroyed against a barrier on live television, no insurer pays for it. The teams simply absorb the cost, building a crash damage budget into their finances every season because the odds of a car being wrecked are so high that no underwriter would ever write that policy at a price a team could afford. Insurance in Formula One covers the things that are rare and catastrophic. It does not cover the things that are routine and expensive. The routine destruction is just the cost of doing business. So if even crashes are priced in, what does it take for a human being to become uninsurable? For the answer, you have to go back to an era when Formula One was, by any honest measure, a killing field. 15 drivers died in the 1950s, 14 more in the 1960s, another 12 in the 1970s. For long stretches, a driver entering a season had a real and calculable chance of not finishing it alive. To an actuary, this is not tragedy, it is a number, and when the number gets high enough, the price of a policy climbs until it is either unaffordable or simply not offered. In the deadliest years, covering certain drivers was less an act of insurance than an act of charity. What changed was not the bravery of the drivers, but the mathematics of the sport. After the deaths of Ayrton Senna and Roland Ratzenberger on a single black weekend in 1994, Formula One rebuilt itself around survival. Crash structures, the halo device, runoff areas, and medical response transformed the odds so completely that only a handful of drivers have died at the wheel in the decades since. As the risk fell, so did the premiums. The same actuarial logic that once made certain drivers almost impossible to cover now made the entire grid far easier to price. Safety, in the end, is not just a moral victory, it is a financial one, measured in the falling cost of betting on a driver to survive the year. No story captures the strange relationship between racing and risk better than Niki Lauda's. In 1971, long before he was famous, Lauda did something almost poetic in hindsight. To buy his way into a Formula 2 seat, he took out a loan against his own life insurance policy. He was quite literally borrowing against the value of his own death to fund a career that might cause it. The BET paid off. He reached Formula One, and by the mid-1970s, he was a world champion with Ferrari. Then came the 1976 German Grand Prix at the Nürburgring. Lauda lost control, his Ferrari burst into flames, and he was trapped in the fire for nearly a minute. He suffered severe burns, inhaled toxic fumes that scarred his lungs, and was given the last rites in hospital as a priest prepared for him to die. He did not die. 42 days later, his wounds still raw and seeping through his bandages, he climbed back into a car and finished fourth at the Italian Grand Prix. It remains one of the brave acts in the history of sport. But think about what that crash did to him on paper. A man who had nearly burned to death with permanently damaged lungs and a documented willingness to race while grievously injured is an underwriter's nightmare. Pre-existing conditions, a proven catastrophic risk profile, and a temperament that ignored physical limits. These are precisely the factors that push a premium beyond reach. And here is the final twist. When Lauda eventually walked away from racing, he poured himself into aviation, founding his own airlines and becoming a serious figure in an industry built entirely on managing and pricing risk. The man, once too dangerous to cheaply insure, spent his second life on the other side of the equation. Lauda's case points to the real reasons a driver becomes uninsurable, and they have changed over time. In the deadly decades, it was the sheer statistical likelihood of death. Today, with the sport vastly safer, the obstacles are different. A serious pre-existing injury can make cover prohibitively expensive. So can an aggressive driving style that underwriters judge as reckless, the kind of defending that draws criticism from former champions and raises the odds of a major incident. A driver's activities away from the track matter too, because a policy may exclude or penalize dangerous hobbies, and many drivers genuinely love fast, risky pastimes. Age, medical history, and even the specific circuits on a calendar can all move the price. What it comes down to is this: insurance is a bet on the future, and the people who make that bet for a living are ruthlessly honest about probability. They do not care how brave a driver is, how beloved he is, or how brilliant. They care only about how likely he is to cost them money and how much. For most drivers, that calculation produces a high but payable premium, quietly spread across a room full of underwriters in London who will never watch the race. For a rare few, the number simply runs off the page and the answer comes back that no price is high enough. That is the uncomfortable truth beneath the glamour of Formula One. Behind every driver waving on the podium is a ledger, and on that ledger, some lives are considered too expensive to guarantee.